Ladies and gentlemen, good day and welcome to the All Cargo GATI Limited Q2 and H1 FY24 results conference call hosted by Dollars Capital Markets Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be no opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Jain from Dollars Capital Markets Private Limited. Thank you, and over to you, sir.
Thank you, Lizanne. Good morning, everyone. On behalf of Dollars Capital, I welcome you all to Q2 FY24 earnings conference call of All Cargo GATI Limited. We thank the management for providing us the opportunity to host the call. From the management side, we have with us Mr. Phil, Managing Director and CEO, and Mr. Anish Mathew, CFO of All Cargo GATI Limited. Now I hand over the call to Mr. Phil for opening remarks, followed by the question and answer session. Thank you, and over to you, sir.
Good afternoon, and thank you, Abhishek. Good afternoon and a warm welcome to everyone on our Q2 and H1 FY24 earnings conference call. We have uploaded our results and earnings presentation on the stock exchanges and company's website, and I hope everyone had an opportunity to go through the same. As mentioned, along with me, I have Mr. Anish Mathew, the Chief Financial Officer of All Cargo GATI Limited, and our investor relations team. I will now share an overview of the economy, industry, and business, after which we'll hand over the call to Anish to discuss the financial performance of the company for the quarter and half year ended September 2023. The IMF has projected that global real GDP growth will remain steady at 3% in 2023, although they have revised their 2024 forecast slightly downward to 2.9% from the previous estimate of 3%. The total global output is estimated to be around 3.4%, which is still below the pre-pandemic projection. The global economy is limping along its path to post-pandemic recovery. There are several factors that continue to raise concern. These include the volatility of oil prices, sluggish productivity growth, and ongoing geopolitical tensions such as the Israel-Palestine conflict. While China is grappling with its real estate crisis and diminished external demand, there is no respite for major economies like US and UK too. Although the risks of banking instability have softened, commodity prices could become volatile on the back of geopolitical tensions. Turning our focus to India, it's worth noting that it currently holds the position of the 5th largest economy. With robust growth projections, it is poised to ascend to the position of the 3rd largest economy by 2030. IMF has projected strong growth in India at 6.3% for both 2023 and 2024, with an upward revision of 0.2 percentage points for 2023. This upward revision is attributed to India's robust domestic demand and the increasing influx of foreign investment. In addition, the e-way bill volumes for the September 2023 totaled 9.2 crore, and for August 23 they were at 9.3 crore. These figures signify resilient domestic trade and transportation activity, reflecting an overall improvement in demand. Furthermore, GST collection in September 2023 reached rupees 1.6 lakh crore, marking a 10% year-on-year increase. Revenues from domestic transactions, including the import of services, saw a substantial 14% year-on-year growth. Moreover, the road logistics sector in India is anticipated to experience favorable growth supported by strong domestic consumption. On the company front, firstly, I would like to bring your attention to a recent update regarding change in your company's name. The change has been officially approved by the Board of Directors, and the company is now known as All Cargo GATI Limited, formerly known as GATI Limited. We have applied for exchange approvals, and name change on exchanges should happen in the next 4 to 6 weeks. Another update that I would like to share is that we have appointed Mr. Sandeep Kulkarni as the Chief Operating Officer at GATI Express and Chain Private Limited. Sandeep comes with 22 plus years of rich experience. He was in the Indian Navy from 2001 to 2011 and started his corporate career with Larsen & Toubro in 2012. His last stint was with Tata Click as Chief Supply Chain Officer.
625.
Now let me provide you with updates on our initiatives across the pillars of growth, beginning with sales acceleration. We are reaping the benefits of this initiative with an 18% year-on-year increase in volume. Some of the new initiatives that we would be taking include yield management, collection drive, and use of data science. Under yield management, we have set a minimum selling price for all new business along with ancillary charges. We've also set up a dedicated tele-sales team for MSME customers to provide the right support at the right time. We have appointed regional key account managers to promote faster resolution. Our focus remains on enhancing customer retention, capturing a greater wallet share, and expanding the customer base. Our dedicated sales force plays a pivotal role in identifying opportunities within existing territories and exploring new markets. Infrastructure amplification. With Bangalore hub operational, we now have 5 operational super hubs. We are well on our way to complete phase 1 of our infrastructure amplification. The Bangalore super hub is spread across 110,000 square feet with 68 bays for loading and unloading of trucks. Large number of bays will enable faster loading and unloading and also shorten the cooling time. The Bangalore hub is a facility that we would like all of you analysts and investors to visit and will be happy to facilitate the same. Operational excellence. This is one of the key areas of focus for us. We embarked on a nationwide program to train GATI associates. I am happy to share that we have successfully completed training of 783 GATI associates out of nearly 3,000 in the first phase. Furthermore, we are dedicated to elevating the quality of our service parameters, aiming to set new industry standards for excellence. Would also like to highlight here that we have converted an additional 26 PIN codes in addition to the 1,000 that we had spoken about last time from ESS to direct. On the technology front, we have rolled out the dimensional weighing and scanning machines across 4 of our locations. These DWS machines help in reducing revenue loss due to inaccurate dimension and weight capture. This is just the beginning and will help improve billing transparency, revenue collection, and simplify the process. We have also deployed biometric attendance for handlers across 9 locations. We have rolled out digital dockets for retail customers across India with 99% compliance. E-dockets for MSME and strategic customers has been rolled out in 4 of our 20 EDCs. In conclusion, at All Cargo GATI, our vision revolves around maximizing value creation for each stratum of the society. We are dedicated to making a positive impact on the communities in which we operate and create a more inclusive society. With this, I would like to hand over the call to Mr. Anish Mathew, our CFO, for financial highlights. Over to you, Anish. Thank you.
Thank you, Phil. Good afternoon, everyone, and a very warm welcome to our Q2 and H1 FY 2024 earnings call. I'll take you through the highlights of financial results for the second quarter and half year ended September 2023. I would like to start with the highlights of our express business first. Your company has shown strong performance in terms of volume, driven by pre-festive demand. Total tonnage handled for Q2 FY24 stood at 333,000 metric ton as compared to 283,000 metric ton handled in Q2 FY23, representing a remarkable growth of 18% year-on-year. Revenue from express business stood at rupees 385 crores in Q2 FY24 as compared to rupees 370 crores in Q2 FY23, a year-on-year growth of 4%. Corresponding gross margin stood at 23.3% for the quarter ended September 2023 as compared to 28.8% in the same quarter last year. EBITDA for the express business stood at rupees 15 crores in Q2 FY24 as compared to rupees 21 crores in Q2 FY23. Client mix for the quarter ended September 2023 for KEA, SME, and retail stood at 65%, 18%, and 17% respectively. For the half year ending September 2023, tonnage handled during H1 FY24 stood at 625,000 metric tons, thus registering a growth of 11% as compared to H1 FY23. Revenue from operations from express business stood at 752 crores, registering a growth of 2%, and EBITDA stood at 31 crore rupees, a decline of 20% as compared to H1 FY23. I will now move to discuss the performance on a consolidated basis. Revenue for the quarter ended September 2023 stood at rupees 442 crores as compared to 435 crores for the same period last year. The gross profit for Q2 FY24 stood at rupees 91 crores as compared to 108 crores for Q2 FY23. The EBITDA for Q2 FY24 stood at rupees 15 crores as compared to rupees 20 crores for Q2 FY23. I would like to highlight here that our continued efforts in reducing the DSO resulted in change in estimate of provision required for both deductions and expected credit loss. The resultant margin impact on EBITDA is approximately 1.1%. With respect to the sale of non-core assets, I would like to bring to your notice that out of rupees 81 crores of non-core assets identified for sale, we have, as on 30th of September 2023, received advance of rupees 18 crores, and we expect the sales transactions to complete by Q3 and Q4 23. We have been providing other key comparative financial performance indicators in our investor presentations. One can refer that for more details. With this, I would like to throw the floor open for Q&A.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Dixit from ICICI Securities. Please go ahead.
Yeah, hi. Good afternoon, everyone, and thanks for taking my question. I have a couple of questions. The first one is essentially on the margin profile. Now, we had guided earlier that that EBITDA margin would improve to 7.5 or 6.5% by end of Q2 FY24, but looks like we are still far away from that level. Another question is that since our super hubs are also operational now, volume uptick is quite visible, then what is inhibiting the margin expansion? And what would be the realistic time frame in which we would see us going to 7.5% EBITDA margin?
Thanks. I was sure that this question will be the first question this time. So let me give you a couple of reasons why you see that in this month our margins are low. The most important reason is that our yield has dropped during this quarter. And the reasons for yield drop are quite a few. So let me start with the first one being the mix. If you see our mix, it has now changed to 65% large and 35% between MSME and retail. And there are reasons for this. Number one is, if you remember, we have in our retail business introduced the e-docket. And whenever you introduce technology, a lot of transparency comes into the picture and you get an initial dip in your numbers because of that. But it stabilizes and you get to know what exactly is your business, and we have now learned this and we know how and where to get our retail business going up. Point number one. Point number two is, after completion of 2 years and talking to a lot of our larger customers, we realized that a lot of the business, which is intra-state business, which we call within zone business that the customers have, was not really coming to GATI because GATI's pricing was not attractive for that intra-zone business. Now, you have to understand that most of our business that we were doing earlier was between zones, which means Bombay to Delhi or Bangalore to Kolkata, etc. But more and more, the supply chains of specifically e-commerce and retail industries are moving to intra-zone because more and more warehouses are coming closer to the customer. So when you start pricing for intra-zone business, your yield does fall, but corresponding costs have to improve. And that is something that we'll be looking at, and we have already started doing now in this quarter, that the product 23, which we have, which is an intra-zone product, the costing for that product has to be far, far more lower than the costing for the 24 products that we have. The third one is, as more and more customers kept telling us that our direct PIN codes were lesser than those of competition and that we were not getting business because of that. So we have increased over 1,000 PIN codes to direct, and the effect on the volume has come in now in this quarter. However, the cost corresponding to that which we were incurring needs to also be looked at, which we are started looking at now. So a combination of these three and a few more is what has got our volumes up, and we are very happy that we've been able to get our volumes up because we have identified all the areas why the volumes were not up. It is now up to us how to kind of increase the yield and optimize the cost to get that gross margin increase that we are looking at. So that's a little long answer, but I thought it's important to give it because I'm sure out of the 100-odd participants on this call, everybody would be wanting to ask that question, and I hope I have answered it to your satisfaction.
That was quite an elaborate answer. Just wanted to get a little bit of more milestones that we have in mind. So I understand that this takes time. Of course, it doesn't happen overnight. But just in terms of milestones, let us say end of FY24, what kind of exit rate can we expect in terms of EBITDA margin?
So I will stick to one thing, that all of this will culminate to what we have said, 10 to 12% by 26.
10 to 12% by 26. Okay. The second question is it's a more of a bookkeeping question. This quarter, we saw operating expense declining significantly. Other expense declining significantly, both on QOQ and YOY basis. So just wanted to understand whether there is some sort of provision that was written back or, there is some one-off factor here. Because volumes have gone up, but other expenses have come off significantly.
Anish, you may want to answer that.
Yeah. So I mentioned in my speech that there is an estimate in the provisioning requirement as basically based on our collection drive. So that has resulted in an additional provisioning, in the revenue line item, and the corresponding, reversal of ECL provision, is reflecting in the other operating expenditure. So that is the reason why you see quarter on quarter as well as on a year-on-year decline actually in the operating expenditure.
I missed the opening remarks actually. So what would be the quantum of that, if you can repeat?
Well, approximately 3.5% is the impact to the revenue line item on account of this change in estimate, and correspondingly, around 1.5% impact is coming as a credit to the operating expenditure on account of ECL reversal.
Okay, fair enough. Thank you, and all the best.
Yeah.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Dwanil Desai from Total Capital. Please go ahead.
Hi, good afternoon, everyone. So my first question is that you elaborated on the reasons why the realizations or yield has gone down, and it has a consequent impact on margins. My question is that I'm sure such kind of initiatives you would have planned out 3-6 months in advance. So, was there any inkling of such things coming in? And as you scale up your intrastate business, how should we look at average yields? It has dropped significantly YOY and QOQ both. So how should we look at that going forward? That's the first question.
So I think our key accounts who were already doing business with us and who had a lot of intrastate business, once we revised the pricing for them, the volume started flowing in, and therefore it was like during this last 3 months that we really volume uptake from them on the intrastate. When you look at intrastate, while the yield is lower than interstate, the cost also becomes lower because the line hauls that you incur, which is your one single largest cost, reduce. And because of that, your margins should get better. And that is what I spoke about in my first answer over there. While volumes came in, we have started looking at costs. There is a little lag between the two, and therefore that will be seen in this quarter.
Okay, got it. Second question is, I think we have talked about deductions in the past, and we also indicated that, should kind of almost get over by Q2. So first of all, was there any significant impact of that too on our realization and margins? And how should we look at it in the H2?
Anish, would you like to answer this question?
Yes, so I think as we in the last earnings call and our multiple discussions with all of you, we did mention that we are aggressively pushing to kind of get the debtors, clean it down, and we have kind of almost completed that exercise, exercise in Q2. And that is what, is kind of reflected in the current, quarter's performance, where because of resultant of this cleanup, we had to kind of increase our deductions estimate, and which is reflected in the revenue. And since that has an impact on the ECL provision, we have made a corresponding reversal of ECL provision, and which is reflecting in our operating expenditure. So the net impact of this, the change in estimate because of this additional provision required in the deductions as well as reversal of ECL is almost 1.1% of revenue. That's the impact of it.
Right. So should we assume that net of this deduction, the yield would have gone up by whatever 3.5% that you have deduced from the revenue? Is that a right way to look at it?
Yeah, the right way to look at this basically in terms of absolute terms, the reported EBITDA for the quarter is 15 CR. So if you kind of, really kind of, take the impact of this one, ideally your profitability for this quarter should have been 19.8 crore rupees. So the margin of 3.9% that, would have been 5%.
Got it. The second question is, so let's say, we are at 23-24% gross margin and we are at 29-30%. So with all these things kicking in and you are relooking at your cost items, what is the timeline that you're looking to go back to, let's say, 28, 29, 30%? Is this a couple of quarters or is slightly longer than that?
So I said this earlier and I'll repeat this. All these measures that we are taking are towards our committed end goal of 10 to 12% EBITDA margin by 2026. So it's a step-by-step approach, and we will see a little up and down in between, but we are making the foundation such that we hit our 10 to 12% in 26.
Yeah. The only concern, sir, is that we had guided a path, and now I think because of various reasons we are kind of going backwards. So when will we come on the right direction? Directionally, when can we start growing again? That's the question.
The directional growth, so you're already seeing, if I'm growing my volume at 18% year over year and 14% over the previous quarter, that's directional growth.
I'm saying EBITDA level.
Sorry?
I'm talking about more from margin perspective.
Yeah, so like I said, once you have a certain volume, the margins will come with that by looking at various measures of both yield improvement and cost optimization on those volumes.
And last question, sir. I think we have been focusing on SME, for some time now, and that proportion keeps on shrinking. So I think you talked about impact of dockets, introducing dockets on the retail side of it. So was SME also impacted because of that? And in your opinion, is the growth on the SME side lower than what you anticipated given all the efforts that you have put in?
So I think the growth on the large accounts is what makes the percentage differential. It's not the degrowth on the MSME side in that respect. So while MSME growth has not been as much as we wanted it to be, but I think growth on the large accounts has been a lot more. So that is one. The second is, I think last quarter we had announced that we have now got a digital marketing head, and his focus with his team is going to be on acquisition of MSME customers. We have just recently set up a separate MSME cell under him, and this particular will be doing a combination of digital marketing and calling to the MSME to get more MSME business into the organization.
Okay, got it. Thank you. That's it for me.
Thank you. The next question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Yeah, hi sir. Sir, my first question, and of course I'm hopping on the same thing. Sir, how much was your intrastate volume this quarter as a percentage? If you can give a ballpark number that we took, which was lower margin business for us.
Ladies and gentlemen, the line for the management has got disconnected. Please stay connected while we reconnect the management. Thank you. Ladies and gentlemen, thank you for patiently holding. We now have the lines of the management reconnected. Over to you, sir.
Yeah, I'm not sure whether the management heard my question. Should I repeat?
Yes, please.
So, sir, my question was, you mentioned that the realization was lower because of the intrastate business that we took, because our rates were not competitive. Can you talk a little bit about how much was that business for us, and assuming, and how much did it grow? Like, what is the quantum of that business for us this quarter?
So let me just correct you. When you say because our rates were not competitive, what I'm trying to say is because for that product, the rates were not competitive. Okay. When we are looking at the growth of the large customers that has come in by way of a percentage share, that is where we have got more of the zonal business, as I call it. For example, with one single large customer, more than 50% of the business growth has been through just the zonal business that we got from them. So it has been a good increase of business for us, and that is how we have kind of grown our volumes also.
No, I understand that, sir. What I'm failing to understand is that even if, let's say, it has suddenly become 15-20% of our overall business, how can it shrink the realization by 8.5% for our entire company, which is where my struggle is?
So like I said, there is not a single reason. There were many reasons. I gave you 2-3 reasons. One was our retail business has shrunk, which is a high yield business, because of the e-docket that we put in. And I gave you another reason, that the zonal business had also not been there in our portfolio, which has come in. So I just gave you those as examples of why our yield has fallen.
Okay. And sir, my last question is, so now, is it fair to assume that we are scrapping all our intermediate guidances and going directly to FY26 guidance, and there is no roadmap towards achieving that guidance? Because as you say, it's a step process, quarter by quarter. But we are only talking about now FY26 guidance. Is that fair?
On a guidance principle, yes. Hello, can you hear me?
Yes, sir. Mr. Mehta, are you done with the question?
Yes, that was my last question.
Thank you. The next question is from the line of Himesh Desai from Dollars Capital. Please go ahead.
Hello, am I audible?
Yes.
Hi, so I just have a couple of questions. One was on the hub perspective. We have operationalized new hubs like the Bangalore and the one we have recently. So what is your utilization level on these hubs?
So Bangalore hub has not even completed 1 month still. We are still operating dual from the new hub and a little bit from the old hub. I think we need to give a hub at least a quarter before we talk on the utilization. Having said that, because the volumes have gone up overall for us, our utilizations overall of all our hubs have increased for sure.
Okay, and so in your investor presentation, it was mentioned that the Indore hub will be operational, like the estimated operational timeline would be Q3 of this year. So are you in line with that, and what will be the capacity that will hold that hub?
So yes, we are on time with that. We will get the Indore hub, and from a capacity perspective, if you get in touch with our investor relations, they will give you all the details on the hub.
Okay, thank you. And my second question is, when can we expect the synergy benefit from the contract logistics arm of All Cargo to kick in?
So the synergies have already started kicking in. We already see that the cross-sales effect that we have done, both GATI selling warehousing business for all cargo supply chain and all cargo supply chain selling express business to their existing customers has given us a lot of new business also. So it has already set in.
Okay. Thank you. That's all from my side.
Thank you.
Thank you. The next question is on the line of Nirav Savai from Abacus. Please go ahead.
Yeah, thanks for the opportunity. So my question is about the yield differential. If I were to look at intrastate and interstate, what would be the yield differential on a blended basis?
So for large customers, the differential would be to the tune of about 20%.
So 20% in the sense if you have like gross margins, so let's say.
I'm talking yield, not
Yeah.
yield. That means that if the large customer's yield is 100, then the yield of the inter-zone would be 80.
Okay. So for the large customers only, we largely do this interstate, right? Or would we be doing for smaller customers as well?
No. So right now, that is where we identified and that is where we got our growth from. But now that we have done it, we will also go to the smaller customers to do the same.
Okay. Right. And the second thing is about this rental cost, which flows down below the EBITDA level. Now, once we are done with a large part of the expansion, let's by FY25, how do we see this 26 onwards? Because we have given this time, depreciation on ROU assets is about 25 crores and interest is about 10 crores, so cumulative 34 crores. So how do we see this stabilizing once all the hubs are, start commissions, let's say by FY26 onwards?
So I'll let Anish answer this question. Anish, please answer this question.
Well, there is no question of stabilization because as and when we kind of, open new hubs, so we will have this lead coming in and, you will have the index impact coming in. So, this is a continuing process, right? It will never end. Now we have started Bangalore. That impact is going to come in, and as we kind of keep doing that, then we will have those kind of flow through coming in, both in the EBITDA line as well as the depreciation on the finance cost line.
I was trying to understand in the first half, it's about 34 crores. The first half of FY24. So
yeah.
How do we see this once the current expansion plan, what we have, is over, and 26 onwards, obviously this expansion will continue, but from the given set of new hubs which we are planning to add, let's say Hyderabad, Cochin, how do we see this number on an annual basis? To get a sense on pre-index kind of a EBITDA number.
Okay, I need to work it out as specifically, to kind of give you the correct picture. So let me just come back to you. I do remember that I've shared this one to a couple of investors in the last meeting. I'm not sure whether you were part of that one, but I can provide this information separately.
No, sure. We'll take it off.
It will enable you to really help you in terms of your projections. I can give you a kind of framework in terms of for a specific warehousing space, what would be the rental and what would be the impact actually of interest, between this above EBITDA line as well as the depreciation of the finance cost.
Right. Because if we adjust this number, then pre-index EBITDA margins are very, very low compared to other industry peers. So just wanted to get a sense when volume actually starts kicking in, how will we see this pre-index EBITDA number once entire expansion is over?
Well, I'll just kind of give one addition to what you said. See, when you say comparative analysis, I don't know which is the competition you're referring to. The purpose of the index is basically to kind of have a like-to-like comparison. We kind of have an asset-light model. Maybe the competition which you're referring to as a asset-light model. So you cannot compare, like-to-like basis for an entity which is following two different approaches to kind of for the investment. So in my view, ideally you would need to kind of do a comparison based on what we are showing versus what others are showing. You cannot really discount that one. But if you really want to kind of look at the real cash flow, that's a different perspective altogether.
Right. So just wanted to get a sense that if this kind of a volume growth continues, what can be a pre-Ind AS EBITDA number, assuming all the rental costs are there, and then what kind of EBITDA and cash flow we can make?
Yeah. So we have for this quarter, for this September ended, published our balance sheet as well as the cash flow, and our cash flow kind of clearly state what is the pure cash flow and what is the pure Ind AS impact. So you can refer to that one. You'll get a very good indicative of the pure cash flow. Irrespective, if you still further need any clarifications or inputs, we can provide you actually with those information.
Sure, sir. Look at it and maybe you can take it offline.
Sure. Thank you.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Jainam Shah from Equirus Securities Private Limited. Please go ahead.
Yeah, thanks for the opportunity. So my question relates to the top line. So basically, if we see our consolidated top line for 1H versus 1H, it has been largely stable despite some 10% of volume growth in express business. And we believe that express would be the major growth driver for us going forward, not the fuel business. And we are just like 2 years away from our targeted FY26 3,000 crore of revenue. So how we are looking to grow to this 3,000 number, given that the growth rate should be somewhere around 20-25% in total, which would be like 2x of the industry growth. So how we are looking at it?
So clearly, growth from for our business comes from 2-3 areas. One is volume growth and the other is yield growth, right? If we already have shown volume growth over year on year as well as over last quarter, then as we apply a yield growth to that incremental volume, the revenue growth comes in by itself. So it's a very good situation to be in where your volume has grown and now you have to apply the yield growth to that volume, and that's exactly what our sales and marketing team will be engaging with the customers and doing for us.
Got it, sir. That's it from my side. Thank you.
Thank you. The next question is on the line of Riya Mehta from Equitas Investments. Please go ahead.
Thank you for giving me the opportunity. My first question is in regards to, you were just saying that now we are seeing a trend where intrastate orders are more and that's the way the commerce is working. However, the yields are lower in that segment. So could you elaborate how going forward this would entail us to reach our guidance of FY26? Because if we reduce our realization to become more cost competitive, that would have an impact on our margins.
So it doesn't work that way. When you do intrastate business, your cost also reduces dramatically because your distances that you are moving, which is your main line haul and feeder cost, reduces. In the transportation business, as your distances go larger, your cost per kilometer also increases. And therefore, as distances grow shorter, your cost per kilometer reduces. So basically, lower yield due to the product change does not necessitate reduction in gross margin.
But as you mentioned, the yields are almost 20% lower than the normal large clients, right? Intrastate.
So the cost has to be more than that, lower.
Okay, the cost will be more. So it is more profitable than intrastate. Hello. Hello.
Yes. Thank you.
Yeah, my next question is in regards to the 3.5% charge you said, which is on account of provision. So could you elaborate on what account are these provisions, and is it a one-off or it can be a recurring thing?
Well, that is not a recurring thing. As we said, this is basically a revision of the estimate which we have done, basically based on the cleanup exercise which we have done. So, which resulted in the incremental provision of around 3.5%. That also resulted in kind of having a much better quality debtors. That resulted in kind of a requirement for us to kind of make a lesser provision. So that impact or credit is coming in the operating expenditure. Very simple to your question, the 3.5% is basically a one-off. We don't expect this to kind of come in as a recurring expenditure in the coming quarters.
Right. And in terms of our entire IT system and software, we've done a tie-up with Tech Mahindra. So what kind of investments are we seeing there, and how will it come across?
We
haven't put out the number in the public domain yet, but it is definitely a very large investment. The process has started. It is going to be done in approximately 4 to 5 waves over 18 months. We have completed wave 1, and we are pretty happy with what TechM has brought to the table so far.
Okay. And will you be depreciating it after the entire thing is commissioned, or as and when the wave gets commissioned?
Anish?
Most likely it will be after the entire project is completed, because then that time only we can account as an amortization expenditure.
Okay. And are we taking any debt for the same?
As of now, no. Okay, if you look at the balance sheet, the total debt for the net debt, for All Cargo Gati stands at 41 crore rupees. So we have a external borrowing at around 140 crore rupees and approximately 103 crore rupees of cash and cash equivalent. And we still have a pretty good amount of asset held for sale. I mean, I'm saying pretty good amounts, almost like 80 crore rupees of asset held for sale. And that realization also, would be, we would be able to kind of get that realization by Q3, Q4. And I think we believe that, that is sufficient enough to kind of really fund for the capital requirement.
Right. Okay, so we won't take any external debt.
Yes, as of now, we don't have any plan to take an external debt.
Okay, thank you. That's it from my side.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Rishabh Shah from RBSA Investment Managers. Please go ahead.
Just one clarification, sir. When you're talking about the 3,000 crore revenue target, are we including any revenue coming from the fuel station business if it is not divested by then, or is it only for the express business? Hello.
Hello.
Yeah. Did you get my question, or should I?
Right now, when we talk about any figure, we talk about the existing businesses put together, right? We don't know as and when the fuel business will go away, irrespective whether it is with or without, we will touch 3,000 crore.
Okay. And since the cost differential in the intra-states are much lower, is it possible to mention in percentage how much lower than the interstate?
I already mentioned that it is about 20% lower than interstate, the yield.
No, I'm asking about the cost. You said the cost is much lower, so that I'm asking about the cost percentage.
So it is a lot more lower than the differential in yield.
Okay. Thank you so much.
Thank you. The next question is on the line of Ronald Sioni from Sharekhan Limited. Please go ahead.
Yeah. Good afternoon, sir. So just on the volume front, the strong volume growth which we have reported, can you touch upon the segments or sectors which have led to such a high growth? Also, this volume growth, has been from the new clients, or this was, just taken back, or the reversal of volumes which has happened and this has led to high growth?
Majority of this volume has come from our existing clients, although we have added new large clients also to our portfolio.
Okay. And some of the sectors which have been there, because we have been seeing...
Primarily, I would say it has come from retail and consumer durables.
Oh, okay. Thank you very much.
You're welcome.
Thank you, ladies and gentlemen. That was the last question. I now hand the conference over to the management for the closing comments.
Thank you, everyone, for attending this call. If you have any further questions, please reach out to our investor relations team, and we look forward to meeting with you all in the next quarter too. Thank you.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Dollars Capital Markets Private Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.